or incorporate a limited company. Clearly I forgot to print out my corporation tax return, but oh well, not paying reception £3 to do it for me. Let's look at the tax impact of having a limited company versus being a sole trader and the reporting requirements that will cost us money in accountants' fees to get the job done properly. We are going to incorporate our business, so we need to ensure it qualifies for incorporation relief. Because we are disposing of business assets that we are holding personally into our limited company, we don't want any capital gains tax impact on us. So we're a sole trader. We're filing a self-assessment tax return once a year. We are paying Class 2 and Class 4 national insurance contributions. With Making Tax Digital, we are going to be filing 4 reporting returns every year in order to comply with the new regulation. If we incorporate a limited company, we are going to be filing 1 corporation tax return every year. We are, however, going to have to get accounts produced in order to complete this corporation tax return, and these accounts are going to have to be tagged by an accountant, which basically means HMRC can read the accounts when you submit the tax return, because the accounts have to go in with a corporation tax return. So that is an extra expense. Payroll, so sometimes it's tax efficient to take a small salary from your company. When you're doing this, you are going to have to file every month payroll reporting, and at the end of the year you're going to have to file more payroll reporting. There might also be, depending on the level of salary, national insurance contributions both for the employer and the employee. A salary is actually deductible for corporation tax purposes, so that salary will come off your profit, so you get a deduction for that salary. However, dividends, which is going to be the way you extract most of your profit out of your limited company, are not deductible for corporation tax purposes. So what will happen is you'll pay corporation tax on your total taxable profits in your company between 19 and 25% depending on your profit levels. So then that dividend is going to be taxed again on you personally at whatever income tax rate you're at. The income tax rates for dividends are lower than they are for income. And finally, you will be filing a self-assessment tax return exactly the same as you are now as a sole trader, because you are going to have to report this dividend income which you have received and hasn't already been taxed at source.